We'll start with accounting standards 1. Presentation and disclosures based on accounting standards. Okay, whatever the presentation you do for financial reporting, it should be based on the accounting standards. We'll start with AS1, disclosure of accounting policies. Fundamental of accounting assumptions. Whenever we prepare the financial reports, it is assumed that we follow the fundamental accounting assumptions. These are the three are called as fundamental accounting assumptions. One is being the going concern, another one is being consistency, another one being the accrual. Going concern means an enterprise will continue its operation for foreseeable future, not going to be closed. That's our logic. Consistency means whatever the accounting policies you follow in a year, continue to follow the same year after year also, in future accounting period also. So this will improve the comparability between two financial reports, okay? That's what about the consistency. For example, if you follow WDV method of depreciation over few years, suddenly changing SLM is not meaningful. If you want to change, then there should be a valid reason for this change, else you should not change. So you have to continue to appear at its own WDV method only. So we usually follow the accrual system. It's not the amount paid, it's the facility enjoyed matters to be shown, okay? Earned and incurred will be recorded. The payment may be, say, 10,000 rupees, but actually you enjoy the facilities for 12,000 rupees, then you have to write 12,000 rupees, not 10,000. That 2,000 will be called as outstanding. You have to add it back. Clear? And this is also mandatory. And of course, apart from that, if you don't follow these accounting assumptions, you have to disclose. If you already follow these accounting assumptions, no problem, you don't need to worry about that. If it is not followed, the disclosure requirement is there. You have to give a small disclosure form below the balance sheet. Now, what is called accounting policies? It's nothing but specific accounting principles. Okay, for example, in case of depreciation, we have SLM method, WDV method and all. Cash flow statement, we have the direct method, indirect method. In case of inventory valuation, we have FIFO, weighted average methods and all. In case of goodwill, we have simple average, weighted average method. So these are the policy principles we have. And what method we have to choose and what method we followed earlier year will be called consistency. Whatever the method you follow, you have to continue to follow the same year after year. So in accounting policies, accounting principle and methods of applying those principles adapted by an enterprises for the preparation financial statement. Among the three, what policy have chosen? SLM methods are. In case of cash flow statement, I have chosen indirect methods are. Why do you choose indirect method in case of cash flow statement? Because it is stated that you have to follow indirect method only while preparing the cash flow statement as per AS number 3. That's the logic. AS number 3 says so. AS number 3 says so. Clear? And it should be adapted while preparing the financial statement year after year. Okay. As per AS number 5, accounting policies are the specific principles, bases, conventions, rules, whatever it may be. Practices applied by an entity in preparing and presenting the financial statement. That's a simple logic you can understand. Now, so I have been given two principles, direct method and indirect method. What method I have to choose? Before you choose between the 2 or 3 options you have been given, okay, what are the criteria you have to follow? Primary consideration. Primary consideration. While selecting one of them, by selecting that and applying that, the financial statement should present a true and fair view. Okay, true and fair view. Which method of these is chosen so that your financial statement will express true and fair view? That's the first consideration. The first consideration is not sufficient enough to choose which method you can choose, whether WDV method or SLM method. So logically, SLM method is chosen second than WDV method. So WDV method is a really better method for us. Higher depreciation in the beginning with the lower repairs and lower depreciation repairs in the later, higher depreciation in the beginning and lower repairs in the beginning. Subsequently, later period, the depreciation may be lower because of the aging of the machines, the repairs may be higher. So almost the same amount may be debited to the P&L accounts. That's a logic that as you are debiting the cost for assets utilization, more or less same amount over the period means then the cost of production may be reasonably the same. That's a logic. Suddenly if you are increasing the cost and suddenly decreasing the cost for manufacturing your goods may impact your sale differently. Okay. So that's the logic. In case of secondary consideration, three major considerations are there. One is prudence, another one being, okay, substance over form, another one being materiality. These are the three methods you have to choose. These are the three methods. Let me finish the first one. What is called prudence method? Prudence method being, how can you estimate properly under uncertainty conditions? If the conditions are uncertain, how can you make the decision? Estimate under conditions of uncertainty. In case of profit, you know, if the situation of earning profit is doubtful, you cannot recognize immediately, you can recognize only on receipt, on confirmation. But if there is a small doubtfulness for any payment, you have to make the provisions for that. So worst scenario, even doubt is there, you have to make the provision. In case of best scenario, on confirmation only you have to record. Is that okay? That's a logic, conservatism concept. If there is any uncertain profit, don't consider. On realization of the profit, you can consider. In case of uncertainty in losses, you are not sure whether the loss may happen or may not happen. So don't wait for real loss happens. You have to be double cautious before the loss actually happens. Means you have to be careful for that. Provision should be created. A damage shoot is on you. So if you supposed to lose, then immediately in case of losing the case, you have to pay the penalty or some compensation. So you have to be cautious and make a provisions for paying the compensation. If you are making any shoot on somebody else, if you win, you will get the compensation. That's a possible revenue. Though there's a possibility, say 10 to 20%, never bother about that. After winning, compensation confirm, on receipt of that only you have to recover. In case of profit, on realization you can recover. In case of loss, even if there's small doubt, you can make a provision for. If it is confirmed, then it's a liability. Okay, that's what about in case of certainty, how can you behave? So especially in case of inventory, we follow whichever is lower of cost or NRV. Cost of the raw material being 100, the net realizable value of the assets being 80 stock. Then you have to value at 80 only. Because there's a loss. This is what about the cost. Today if I sell, I can get only 80 rupees means definitely I cannot get more than 80 rupees. The difference between these two is the loss. I can credit in your P&L account closing stock value at 80 rather than 100. So if you are crediting in your P&L account trading account at 80 rather than 100 rupees, your profit may be lesser. Okay, means you are double cautious for that. If the cost is 100, the market value is 120. And what value you are going to record? Only 100. Sir, there's a chance to sell more than the cost is at 20 rupees. Can I show the closing stock value as 120 in the credit side of the trading account? As it is being the gain, you have to wait to realize this. While selling the stock in the next year, you can recognize the profit. But in case of loss, today itself you have to make a provisions or adjust in your book. This is called prudence concept. Hidden reserve, this will be called as hidden reserve, like you are hiding the real profit, right? That is always not permitted. This is what about the prudence concept. Two more points you have to consider for choosing the methods. Okay, one is the substance over form. Substance over form. So this is called legal form. This is what about the reality. Always reality will have first preference and formation. Legal form will have the second priority. Suppose A and B, A hands over his land and building and B gives the cash or part of the cash. And registration pending as on 31st March. Now who is the owner of this asset? A being the owner as per the legal, because the ownership is in the name of A only, registration is not transferred in the name of B. So here A is the owner only. Yet in your accounts you have to consider B being the owner because registration is only a legal formality. Legal formality only pending key is handed over, cash is also transferred, everything is pakka, now no problem. Hereafter, who is going to be the owner? The only owner. Sometimes later, anyhow, this is legal format is pending. Automatically, you have to record B being the owner in your books. Okay, this is called substantive overform. Legal form of the transaction is ignored and substance is accounted. Example, in transfer of property is transferred but deed is pending, yet consider the property to be transferred like, okay. The third point to be noted here is, anything material, then you have to make a note of it. Material means the knowledge of an item which influences the decision of the user of the financial statement. Then it is called material or must be disclosed, okay. So I need to give this information. I have to give this information. If any information I give, it influences the users. If you are being the reader of that, okay, if I give this information, it will influence you, means this is called material information. You have to disclose this properly. You cannot hide this. So for example, if you apply in this examination, the examination fees is not 1,500, it's 15,000 rupees. Provided small note is there. All the students appearing this exam may have the chance to score good mark and pass percentage may be 80%. Now tell me, will you apply for the examination or wait for the next examination? Okay, definitely. Sir, 15, no sir, 30,000 rupees also I will pay, sir. So that is called material. Is it a material or not? The knowledge of an item, this item, okay, pass percentage will be higher in this batch, okay, which influences the decision of the user, whether you can apply or not. You may be waiting, can we go for the next attempt? So by seeing this, immediately you're supposed to go for applying today. So that's called knowledge of this item influences the decision of the user, and this item is an immaterial item, it should be disclosed. In financial terms, in case of expenses, you know, whichever is higher of 1% of revenue or 1 lakh, okay, is disclosed by way of notes, okay, by way of notes. You cannot say sundry income, other income. Your total revenue being 100 lakhs, and commission revenue is there, commission revenue just 50,000 rupees. Now see, 1% on this being 1 lakh and another one being the actual being 50,000 rupees. Between these two, whichever is higher is this one. Any expenses 1 lakh or more than 1 lakh will be disclosed separately. You cannot group that income or expenses into sundry expenses, sundry income. If the income being small one, so for example, if it is being 10 lakhs, okay, 1% being 10,000 or 1 lakh, whichever is higher, 1 lakh. Any value in excess of 1 lakh will be considered as main expenses. If it is being 10,000, it is considered as sundry expenses like. So as per the preparation of profit and loss in schedule number 3 to the Companies Act, that's the rule we follow while preparing the financial statement. And if shares held by the shareholder is more than 5% of the shares, any shareholders holding more than 5% shares should be disclosed separately as per the instructions of balance sheet of the schedule number 3 of this balance sheet act, as a Companies Act. Okay. Materiality is not always a matter of relative size. It's not always relative size. Sometimes a small loss may become greater loss in future. So today it seems to be small petty loss, but it leads to huge loss later on. So in such a case, if those small loss will have greater impact in later period, today itself you have to show that separately as material information, right? And third point is all about disclosure. All significant accounting policies adapted. What policy you have adapted? So while preparing the financial statement, have followed WD method or direct cash flow method or indirect cash flow method, and what are the substance or form you have followed, and materiality, whatever it may be, all the things are disclosed below the balance sheet. Okay. Yes, number 1 is all about disclosures. Disclosure means whatever the accounting standard says, if you follow, no problem. If you don't follow, you have to state why don't you follow, what's the reason for not following, all these things below. And apart from that, each and every accounting standard will say some points to be disclosed below. That should also be followed. All these things are listed in AS number 1. Okay. Can we change the accounting policy, sir? I followed WD method for a longer period. This year onwards, I want to shift from WD method to SLM method. Can I do the change? Of course, you can do. Provided if this change is possible only if the change is required by the law or statute. In case of depreciation for depreciation, especially in case of depreciation for any assets as per the means income tax purpose, you have to depreciate the WDV method only. No, earlier you followed the SLM method. You, because of the legal requirement, you want to shift from SLM to WDV method. Can I do so? Yes, because legal requirement. Or sometimes the accounting standard may prescribe that you have to go for this method only. Or by shifting from WDV method to SLM method, you can make the presentation better and easy understandable. Because of that reason, I'm changing. Okay, of course. These are the three reasons we have. Because of that reasons, you can change the policies from one to the other. Changes of policies is allowed if the change is required by law or statute, by accounting standards, or for better presentation of financial statements. Is that clear? Cannot change regularly. Change policies allowed if the change is required. And if you are making any change from WD to SLM, you have to disclose the change happen, and because of the change, what could be the impact in the financial results also be disclosed. Disclosure. Any change in the accounting policies which has material effect in the current period. Okay, current period. If you are changing from WDV method to SLM method, under WDV method you might have charged only 50 rupees depreciation. Under SLM method you charge 100 rupees. So higher depreciation leads to lesser profit here. So you change from here to there. Okay, 1 second. Now, any change in accounting policies which has material effect in the current period, and if the amount is ascertainable, should be disclosed along with the amount. Okay. So if you are able to ascertain what could be the impact in the profit, rather than 50 rupees debiting, 100 rupees if you debit, then additional debit being 15 now. So you have to intimate that properly. Amount is ascertainable, should be disclosed along with the amount. Amount is not ascertainable, fact to be disclosed. If you are not able to determine what is the amount is affected due to this change, then you have to intimate the status also, at least why you cannot intimate. Okay, but if there is no any material effect in the current period, but ascertainable in the later period. This year we don't have any impact, sir. Because of that, in the later period we have some impact. Fact of such change in later period is to be disclosed in current period. So you have to intimate in the later period also. So these are the things you have to understand. And disclosures. All significant accounting policies adapted should be disclosed. True and fair view of the financial accounts should be disclosed. The disclosure should form part of the financial statement and facilitate the meaningful information to the users. Okay. Any absence of disclosure, it is assumed the fundamental accounting assumption is followed. Means if you are following the fundamental accounting assumptions, disclosure is not required. Disclosure is not required. Any change in the accounting policies, if you are changing any policy, that policy change also be disclosed. So these are the points you have to keep in your mind. Clear? Now let's see how we may expect the illustrations from this particular topic. Disclosure requirement in case where the companies do not comply with EAS. Mandatorily you have to comply with EAS. If you don't follow EAS, what you have to do? Okay. You have to intimate the deviation from accounting standards and reason for the deviation. And because of the deviation, what could be the impact in your profitability? So that's all about the AS number 1. How you can expect the illustrations from this AS number 1? Let's see. In the books of Messrs. Prasant Limited, closing inventory as on 31/3/2022 amounting to rupees 1,63,000. Okay, on the basis of FIFO method. The company decides to change from FIFO method to weighted average method for ascertaining the cost of inventory from the year 2021 and 22 on the basis of weighted average method, closing inventory being 1,95,000. If you adapt the FIFO method, the closing stock being 1,63,000. If you follow the weighted average method, the profit being, the closing stock value being 195. So in your trading account, you might have credited 163, now you are crediting 195 instead of that. What is the additional amount you are crediting? 32,000 rupees, am I right? So now your GP will increase to that extent in this year. The same extent profit will be decreased in the next year. So you have to intimate this properly. So now discuss the disclosure requirement of changes in accounting policies. So you have to disclose what? Change in method of calculation is changed. As per AS number provision, you follow as per AS number provision. Third one will be your profit will decrease by 32,000 in the current year, and simultaneously there will be profit is increased by 32,000 in the current year, profit will decrease by 32,000 in the next year. That's how you can give the answer here. Let's move on to the question number 2. Jagannath Limited had made a right issue of shares 2022. In the offer document to its members, it had projected a surplus of 40 crores during an accounting year to end on 31st March 2022. The draft results for the year prepared on the hitherto following accounting policies and presented for perusal of the board of directors showed a deficit of 10 crores. So while issuing the shares, they projected a surplus of 40 crores. Okay. The draft results for the year, actually, while preparing the draft result, before it gets approval by the board of directors, they came to know there's a deficit of 10 crores. What happens? If I show you the expected profit being 40 crores, an investor purchased the shares using the 40 crores estimations. Later on, they came to know the real profit for the year is only minus 10 crores. Then board of directors shocked. If they want to release this financial report, the investors may question them. No, so you asked me, you showed me 40 crores profit, but now you don't get even 10 crores profit. It's a 10 crores loss. Now the board, in consultation with the managing director, decided on the following. Value year-end inventory at work cost 50 crores instead of hitherto method valuation inventory at prime cost. What happens here? They want to do this way. Value year-end inventory at work cost instead of hitherto valuation of inventory at prime cost. Until now, they followed which method of accounting? Prime cost, direct material, direct labor, direct expenses. The three will be called as prime cost. As per these three costs is 30 lakhs. But in case work cost, it is prime cost plus factory cost also, factory overhead also, means production cost. Production cost includes any indirect manufacturing cost also. Prime cost includes only direct material, direct labor, direct expenses. So these three costs being 30, another factory overhead being another 20. If you add this, then the closing work in progress cost being 50 crores. But if you are writing rather than 30, 50, what happens in your trading and P&L account? In your manufacturing account, rather than 30, if you are writing 50 like in your closing stock value, definitely it rises 20 crores profit here. So minus 10 already. Because of restating this one, their profit will increase by 20. Now, not to provide for after sales expenses during the warranty period. Till the last year, a provision of 2% of sales used to be made under the concept of matching of cost against revenue, and actual expenses used to be charged against the provision. So usually they create the provision, and then whatever the actual warranty period expenses comes, they debit to provision account. The board now decided to account for expenses as and when actually incurred, sales during the year total being 600 crores. Now they want to stop making the provision. If they stop making the provision, 2% on this being how much? 12 crores. You can increase the profit by another 12 crores. You will be increasing. If you don't debit the P&L account for the creation of the provisions to the extent of 12 crores, your profit will increase by 12 crores. Now, provide for permanent fall in the value of investments, which fall had taken place over past 5 years, the provision being 10 crores. So this year they plan to make a provision for a loss in investment. If you debit this, what happens? Your profit will decrease. As chief accountant of the company, you are asked by the managing director to draft notes and accounts for inclusion in the annual reports. So now these three will be included, not only adjusted, you have to include this as a notes to account. See, profit increases by 20 crores, valuing stock at work cost as production is more capital intensive, follows A is number 2. And notes to accounts, profit increases by 12%, the profitability of defect is reduced with the improved method of production. They assume, why don't we make a provision? So we assume we have now improved our production system, because of that the defectiveness will be reduced, so provision is not required. That's how we can give the justification also. And finally, profit decreased by 10%, value investment lower by 10 crores due to permanent fall. So you have to give the note, why do you change this one? After that, what could the total impact in your profitability also be stated here clearly. Clear? Then third question. XYZ company is engaged in business of financial services and is undergoing tight liquidity position since most of the assets of the company are blocked in various claims petitions in special court. So they have a problem here, tight liquidity. They don't have the cash to organize the day-to-day operations. Because most of their assets means blocked by the court. Okay, cannot release, the amount may be freezed. XYZ has accepted intercorporate deposits and it is making its best effort to settle the dues. It is making its best efforts to settle the dues. There were claims at varied rates of interest from lenders from the due dates of ICDs to the date of repayment. The company has provided interest as per the terms of the contract till the due date, and a note for non-provision of interest on the due date to the date of repayment was affected in the financial statement. Okay. So what they do, as they are not able to make the payments for the ICDs, as per ICD, this is similar to the bond issued by a company to the other company. So company to company, it's a lot size, probably 5 lakhs and 10 lakhs, like a minimum lot size. In case of debenture, it may be hundreds of 100 rupees, like, but the ICDs may be 5 lakhs and 10 lakhs lot size. Okay. So I can issue and I can pay the interest, and on maturity I can repay. Okay, that's the logic here. So here what happens now, because of the tight liquidity position, they cannot pay the interest. All the ICDs matured on 1/1/2026, that's how you can assume. But they could not pay the interest as well as amount even at the date, and on the year end 31st March 2026. For the 3 months, there's an accumulation, right? So they have not created any provision. So what happens, as per the terms of agreement on 1/1/2026, along with the interest, they have to pay. But the due date is over. They don't have the money to pay because of the freezing of your money. On the year end, you claimed the represented, means interest outstanding to be as your expenses and liability to this extent only. For this period, they have not claimed anything. There were claims at varied rates interest from lenders from the due date of ICDs to the date of repayment. From this date to this date, ICDs may be ICD issued to A company may carry 8% interest, to B company carries 9% interest. So the maturity date also different, interest rate also different as per the contract date. Okay. Now, as the repayment was affected in the financial statement on account of uncertainties existing regarding the determination of amount in the absence of the specific legal obligation at present as per the terms of contract. Now the question is, we cannot finalize what is the legal consequences I face because of the delay in payment, how much I pay because of the delay, is there any penalty also be leviable? All these things are question mark. Okay, the company considers that these claims are in the nature of claims against the company not acknowledged as debt. They think they could have raise the claims late. They may raise the claims later on, but we have not acknowledged that as debt. Okay, it is not currently debt, like it is not claim accepted by the company. And the same has been disclosed by way of note in the accounts instead of making a provisions in the profit and loss account. State whether the treatment done by the company is correct or not. So they have considered this being contingent liability. No. this date itself confirm, you have to make the payment. If you are delaying, it's outstanding, so you have to make a provision. What they have done is not acceptable. Okay, not acceptable. Okay, see here. Not correct, first answer. Prudence. In case of uncertainty, what you have to follow? Prudence concept. What prudence says? In the case of gain, if you are having any doubt, you can skip. But in case of any loss or liability, even if there is a doubt, you have to make a provisions. Okay. Accounting, fundamental accounting assumptions based on accrual concept only you have to follow. As per the fundamental accounting assumption, okay, from this date, for this date, whether you pay or not, it becomes outstanding, you have to show it. This is called fundamental accounting assumption, accrual concept. And you are not able to decide how much claim you will be paying. Anyhow, you have to pay the provisions as well as prudence concept. And the method they have followed, this being the claim against the company not acknowledged its debt, is not acceptable. Not acceptable. Is that clear? With that, AS number 1 is over. Property, plant and equipment. Property, plant and equipment. A is number 10. So earlier we call the assets being fixed assets, right? But here now non-current assets, under that we have property, plant, equipment terms, predominantly PPE. And this accounting standard, what is the objectives of this accounting standard? This accounting standard prescribes the accounting treatment for PPE. Accounting treatment for PPE. How can you account this? If you purchase the assets, usually debit the assets to bank or cash, whatever it may be, or in case of credit, then credit will be taken. But what are the things that are going to be covered? You purchase the asset by giving the cash or check, or by paying it later. Then assets are debit to creditors for assets. Not only that, sometimes you purchase the asset and issue the shares. Purchase the assets, you can give old assets, exchange of assets. All these things are also be there. No, all these things are grouped here. So by recording it properly, it helps the users of financial statement to understand the information about this investment properly. If there is any changes in such investment, any amount changed in the investment of property, plant, equipment from the previous year to this year also be clearly stated. Now, what are the issues are going to be recognized or studied here in accounting? Recognition of PPE, determination of carrying amount of PPE, determination, depreciation charge, and recognition of impairment loss. Okay, so A company makes a payment okay, okay, from A to B. A makes a payment and purchases 10 lakhs to B, purchase a plant and machinery. Okay, come on, is it property, plant, equipment or not? Okay. For example, A purchases a car. Is it plant and machinery or not? Who knows that? A may be the car dealer, he may sell the car to somebody else for additional profit. Then it is not considered as car asset, right? So, whatever the things they purchase, now question is whether it is an asset or not. Whatever the payment you do, because of that the benefit will be for more than 1 year, then it is an asset. You understand? So that's what about recognition of PPE. And it is going to be used for the company's support service or production service. If they purchase the plant and machinery, with that plant and machinery they can manufacture any finished goods. Even they purchase this car and let out the car, in that case also it's an asset. So these are the ingredients are there to decide whether it's a PPE or not. Second one is, what is the value you are going to record? So what is there? So any doubt regarding the determination of values? No doubt at all. If you pay 10 lakhs to purchase the car, but to bring the car to your place you incur another 50,000 rupees. Add-on services you have to do then another 50, then the car cost is 11 lakhs. But you purchase the car by giving your old car, exchange of car. Purchase the car and you issue the shares and all. How can you determine the value in those scenarios? That's what about the second part. How do I depreciate the property, plant, equipment over the years? Usually SLM method or WDV method. Here we have been recommended only these two methods. The asset of the value of the asset being 100, the depreciation being 20, so 80 rupees is the closing value. 80 rupees is the closing value. Is that clear? 100 minus 20, 80 is the closing value. Clear? Now, if you compare with the market value may be 80 or maybe lesser than that or maybe more than that. So, as per our depreciation strategy, we depreciated 20 rupees and today the value is 80, but the market value is 70. Further loss, then that further loss will be called as impairment loss. But here there is a gain, then it's called revaluation profit. How can we handle that? That's coming under recognition of impairment loss cases. So these are the four concepts you have to keep in your mind while determining the accounting the assets. Let's start with the first one. And this PPE standard applicable for what? Okay. Here especially non-applicable cases. In case of biological assets, wasting assets, if the thing covered under some other accounting standards or all those things, all these assets will not be covered under this in the accounting standard 10, not covered under accounting standard. Biological assets, except barren plant, okay. For example, mango tree, coconut tree, the tree will live for a long life and you can take the plants, means fruits out of that. You can enjoy the benefits year after year for 10 years or 15 years, then those trees are called barren tree. Some trees like paddy, wheat and other millets and all, after the harvest you have to cut and sell. Thereafter there is no any benefit. Fresh you have to grow fresh plants only. Okay, those things are not assets. But in case of barren plant, it will be an asset. Okay, mango tree, coconut tree and all these things are barren plant considered as an asset. Wasting assets like minerals. If you extract the minerals or oil, the deposit in the land or mine may be decreasing slowly. That is called wasting assets. Mineral rights, expenditure on the exploration for an extraction of minerals, oil, natural gas. Similar non-regenerative resources. Once you extract them, there will not be again further chance available for regenerating that. So those are called wasting assets. For these three cases, AS 10 will not be applicable. AS 10 applies to barren plant, but it does not apply to the produce on the barren plant. So example for the barren plant being coconut tree and produce being the coconut. Okay, this AS is applicable for this one, not for this one. For coconut, this will not be applicable. Hope you will be now able to understand. Some more clarification. AS 10 applies property, plant, equipment used to develop or maintain the assets described above. Okay. AS 10 applies to PPE used to develop or maintain the assets described above. So, okay. If you are developing and maintaining any assets, for that any cost you spend also be considered. Investment property defined in AS number 13 should be accounted as per AS number 13 only, not here. That's a prescribed standard for AS number 13, not be studied here. Now, how can I decide it is a property, plant, equipment, sir? Two conditions are there. Two conditions are there to consider this being your property, plant, equipment. One is the useful life of the asset being more than 12 months. Not only that, you purchased and using it for production or supply of goods or services. Using the plant and machinery, you produce some output and sell the output. That asset will be kept with you only for helping to produce anything. Then that is called PPE. Or you, being the car driver, purchase the car and use the car for rental services. Car is my prime asset to generate the revenue year after year, month after month, rental to others. Or sometimes it may not be used for production of the output, but it may be supporting in the office room and other places, like for administrative purposes, includes all business purposes like selling and distribution, finance and accounting. There may be computers also be kept in the finance and accounting department, personal and other functions of an enterprises, okay, personal and other functions. Any property, plant and equipment for the personal department. They may have some refreshment machines, okay, like coffee maker and all, and some other small restrooms facilities provided. So those things are also asset. Hope will be now understand. So what are coming under assets? Two conditions should be fulfilled to treat this being the property, plant, equipment. Clear? Now, items of PPE may also be acquired for safety and environmental reasons, as without which commercial operation is not allowed. Items of PPE may also be acquired for safety and environmental reasons. Okay. You might have seen here or there in the factory, fire extinguisher may be kept, so those are the nice example for this. Okay. As without which commercial operation is not allowed. Note, intangible items are covered under AS number 26, intangible items, and other definitions. So already we discussed what is called biological assets, what is called bearer, plant and all. Living animals and plants are forming part of the biological assets. Bearer plant is nothing but is used in the production or supply of agricultural produce. Okay, what is called bearer plant? The plant is used in the production or supply of agricultural produce. The coconut tree used to produce the coconut and supply the coconut also, is expected to bear production for more than 12 months and has a remote likely wood being sold as agricultural produce. Means cut and sell this as a wooden log for manufacturing or producing any carpentry work, for door and other things, and furniture is not required. Okay. And except for incidental sale of scrap, some trees may be scrapped due to some reasons. Okay, then that can be scrapped. Incidental scrap, okay, allowed. Incidental scrap sale when bare plants are no longer used to bear produce, cut and sold as a scrap like firewood, can be acceptable. Okay, hope you will be now able to understand the definitions all. And what are not bearing plant? Plants cultivated to be harvested as agricultural produce. You are cultivating the paddy, and after the cultivation period you cut completely and sell that entire paddy as a main product to be sold in the market. Trees grown for use of lumber, or some trees you grow and cut and used it for manufacturing furnitures and other things called lumber, right? And plants cultivated to produce agricultural produce. Okay, the plant cultivated to produce agricultural produce. Trees which are cultivated both for fruit and their lumber. So sometimes you produce the plant, cultivate the plant for producing the fruits as well as for lumber and all within 1 year. Annual crops like rice and wheat, all these things are not bearer plant. Agricultural produce is the harvested product of biological assets of the enterprises. What is called agricultural produce? Okay, in coconut tree, coconut is the agricultural produce. So agricultural produce is nothing but coconut, harvested product of biological assets. What is a biological asset? Coconut tree is the biological assets. From the biological assets, you harvest the coconut. That coconut will be agricultural produce. Is that clear? Now, we will go for the agricultural activity. Agricultural activity is the management of biological assets of the enterprises, okay, of biological transformation. Agricultural activity is nothing but any activity involving biological transformation from seed to fruit. Okay, this is called transformation. Seed to plants is the transformation. Okay, that is called biological transformation. Later on, harvest biological assets. For why do you harvest this? For sale, for conversion into agricultural produce subsequently, and into additional biological assets. So these are the work you carry on, no? That is called agricultural activity. Clear? So first part is over. Let's move on to the next part. How do you recognize this as being the property, plant, equipment? Probable future economic benefits will flow to the enterprises. Any property, plant, equipment you purchase, you know today. Because of that, you get the revenue for a number of future periods. That's one information. And cost of the item can be measured reliably. What's the amount you spend for purchasing the plant and machinery? If you are able to identify these two, then you can record. Okay, for example, in case of goodwill, self-generated, automatically generated and creates good value for the company, it has a value. You might have studied the valuation of the goodwill also. As per the accounting standard, goodwill valuation is not accepted here because measured reliably is the question mark here. We cannot measure what could be the value for the goodwill we spend actually. Money spent for generating goodwill is the question mark. So because of that reason only, goodwill is usually, in case of self-generated, will not be recorded. Clear? So it should give the benefit for more than 1 year, and the cost I spent for purchasing or installing the plant and machinery can be measurable, reliable. So these two conditions should be fulfilled. Okay? Now notes. Insignificant items, mold, tools and dies is PPE if aggregate value is material. For example, if you manufacture the table requires wood, steel and all, right? Wood may be say 10,000 rupees. We are in need of steel rupees 5,000, but we may need to have nail, okay? Nail and other things, maybe around 2 rupees. Will you show this being your asset? The value is very insignificant. So what is an asset? Wood and steel being asset because it has long life and the value is also measurable and the value is significant. But nail will have the long life. Okay. But the value is very, very insignificant. Value is very insignificant. But I have almost 10,000 nail. Now what is the value now? 20,000 rupees. Though the value per nail is insignificant, the total nail I have, being significant. Then you can consider this being your property, plant, equipment. Though this insignificant item, but aggregate value is material, then it is called PPE. And usually PPE is expenses if the amount is not material. If one nail, it may be expenses. If it is a significant nail you have, then it is being your asset, property, plant, equipment. So what happens in case of machinery spare parts, sir? Machinery, spare parts, servicing equipment, standby equipment. Okay. This may be either considered as PPE under AS number 10 or AS number 2. If these items not included in AS number 2's definition, then it can be considered as AS 10. AS 2 talks about inventory, stock. It is not considered as a stock, then it will come under PPE. Is that okay? Small spare item, insignificant value. That may be either expenses or it may be shown as a stock under AS number 2. What are the items we come across in stock? Raw material stock, work in progress stock, finished goods stock. Sometimes you have loose tools also being the stock. If those loose tools may not come under AS number 2, seems to be a significant value, then it will come under AS number 10. So PPE as per the conditions then included in AS 10. Else it will be included in AS 2. What are they? Spare parts, servicing equipment and standby equipment. Now, capitalization of cost of remodeling a supermarket. Entity A supermarket chain is renovating one of its major stores. So they have a store, they want to renovate this, modernized. The store will have more available space for in-store promotion outlets after the renovation and will include a restaurant. So after the renovation, they will have some extra space also. Management is preparing the budget for the year after the store reopens, which include the cost of remodeling and expectations of 15% increase in the sales resulting from the store renovation. So they expect, because of this renovation, okay, there is an additional cost, and because of this 15% profit is increasing, okay, which will attract new customers. State whether the remodeling cost will be capitalized or not. Now what about this scenario, sir? Is it going to be considered as part of property, plant, equipment, are expenses. Property, plant, equipment means capitalization. If it is not so, then it is simply debited to the P&L account. To capitalize any expenses you spend, two conditions should be. For recognition, what are the two conditions? The amount you spend should give the benefit for more than 1 year. Is that okay? So because of this expenses, you are able to get the benefit 15% extra hereafter. So automatically it satisfies the condition, so it is better to capitalize only. Don't write directly capitalize or don't capitalize. Write here capitalization because of the recognition criteria first. Write all the recognition criteria and then you can state it is capitalized. Yes, reason, future economic benefit exists and cost can be measured reliably. Because of these two reasons only, we are able to capitalize this. That's how we can name it. Clear? Now, how can you measure the cost of an asset? Very first year, what do you do? You purchased an asset A, B. A paid rupees 1,000 and B gave an asset, property, plant, equipment. Then property, plant, equipment being 1,000 rupees. 1,000 rupees. Okay? Property, plant, equipment being 1,000 rupees. Sometimes later, A again paid another 500 rupees. Now, they have added one more plant and machinery, property, plant, equipment. Earlier, their property, plant, equipment gave us 100 units production. Now, because of paying another 50, I am able to get another 40 units extra. So, how many units I am getting? 140. So, subsequently, what you have to do? You have to add capital expenditure being the property, plant, equipment. Hereafter, the property, plant, equipment value being 1,500. Again, A spends, okay, 500 rupees and he undergoes some activity on property, plant, equipment, property, plant, repair. Because of that, is there any production change? No, the same 140 is there. Now, what happens in this case? This 400 can be debited to P&L account. Can be debited to P&L account. Clear? Now, one more point. This is the beauty of AS number 10. All these things you might have studied in your basic accounts itself, right? So, how can you value the assets? Except the bearer plant and all. Bearer plant may be biological assets and bearer plant may be new for AS number 10. Otherwise, how can you measure the assets value? You can guess it easily. Is it called as your asset or expenses? Also, you can guess easily, right? So, these are the cases you have to understand, right? Now, this part is very important. Okay. A purchased for 1,000. Again, another 500 rupees. Initially 1,000 rupees. This is property, plant, equipment. Again, another 500 rupees is incurred. Can I add this with this plant and machine, property, plant, equipment and state this being single asset? Or will I consider the 1,000 separately as property, plant, equipment 1, property, plant, equipment 2? Can I show this way? Yes, of course you can show this way also. Can show this way also. Is that clear? Clear? Provided if the newly added asset has life totally different than the original asset's life. Original asset's life. This original assets has a life of 10 years. After sometimes I purchase one more assets for the same. It has a life of only 4 years. This asset will be separated, depreciated, 500 divided by 4, 1,000 divided by 10, 100 rupees will be depreciated. So I constructed a house property. Okay. In between, inside, I construct the false ceiling as well as sound absorbing wall proof and all. Okay. These are called what? Interior decoration. Interior decoration has a life of say 5 years, but the concrete structure will have a life of 20 years. And the concrete structure cost us 50 lakhs, interior design cost us 10 lakhs. Now, what is the depreciation? You have to show this separately and show this separately. This will be depreciated over 20 years and this will be depreciated over 5 years. Is that clear? So, when you are able to blend with the existing one, that is called integral part, and this will be called as separate part. Clear? Initial cost to acquire or construct the property, plant, equipment is the starting price. Subsequent cost for replacement or services. If any cost you spend subsequently increases future economic benefit, then it can be capitalized, means it may be addable with the existing cost. No increase in future benefit. So in the black color, okay, we don't have any future benefit. Then this amount can be debited to the P&L account, it will not be addable with the cost. And then additional cost will be addable and shown as a single asset, or this asset separate, this asset separate. If you are showing these two as a single one, then it is called integral or separate. Integral means that will be added to the gross block value. Separate means that will be accounted separately. This is separate account. You have to separately keep the asset and depreciate separately. That's how you can find out the cost of property, plant, equipment. Is that clear? Now, how do you measure, sir? How do you measure the property, plant, equipment? At the time of purchasing, you have to measure at the cost model. 1 year after, how do you measure? After recognition, year after year, you measure it in net book value. Net book value means WDV value, original value minus depreciation. So, first year you show at what value? Cost being 100. And you have to provide the depreciation rate at 20%. So 20 rupees is subtracted. So now 60. Again for the second year, again another 20 rupees is depreciated. Now it is 40. So this is what about the value shown at the time of purchasing. Year after year, the asset value will be shown at book value. Book value means original value minus depreciation, 60, 40. But 2 years once we will go for the revaluation. On revaluation, we came to know the assets value being 60 or 30. So if the value is lesser, I may now show at 30. Is it possible to reduce further 10 rupees? Of course, you can reduce further 10. If you are adjusting for the market value based worth, then it is called revaluation model. If you just subtract the depreciation, so then it is called cost model. This is called cost model. So after the first recognition, every year after year, you show the cost model, means net of depreciation and impairment loss, or you can use the revaluation model. These are the model can be used. Clear? Okay. Now, what happens here? You can purchase the property, plant, equipment, or you can construct your own. If you purchase what's the cost then? You might have studied in your depreciation means taxation chapter, section 43 class 1, the same will be applicable here. Purchase price, non-refundable duties if any, non-refundable. If the duties are refundable, GST, ITC is available, then it can be excludable. Any cost directly attributable to the purchase to bring it and install to your place will be addable. And any dismantling and removal cost associated with the purchased item to be installed should also be includable. Any site restoration cost you are supposed to incur later on also be included. So these costs are going to be added. If there is any trade discount and government grants should be excluded. So you can very easily recollect with the cost you calculate for any assets in various study, okay, in financial accounts as well as in taxation. The same will be applicable here. Instead of you purchase this, you constructed yourself, the factory premises, you constructed yourself. Then whatever the material you spent for constructing should be taken, and labor cost and all other directly attributable cost. And if you are devoting your labor hours for constructing the asset, the salary payable to the labor will not be debited to the P&L account, debited to the asset. See, purchase price, directly attributable cost, dismantling and removal cost, site restoration cost. Okay. Internal profit, if any, will not be includable. Abnormal cost or loss will not be includable. That if there is any such a profit and abnormal cost or loss included, that should be excluded. Borrowing cost can also be includable. Borrowing cost. If the construction takes around 1 year or 2 years, you constructed out of the fund borrowed from the bank. For the borrowing, you are paying the interest. No. Usually interest for construction of any asset will be capitalized, right? You might have studied that also in your direct taxation chapter. In your direct taxation tax chapter, interest on borrowings, if it is post-construction, debit to P&L account as per section 36, specified expenses. If it is prior to the construction, it can be forming part of the assets cost, capitalize that. The same happens here also, but while capitalizing, here we have been given accounting standard AS number 16 for that. For the borrowing cost, we have separate accounting standard AS number 16. So we'll study there so that you will be able to understand the logic easily. In case of bearer plants are recognized as self-constructed assets. In case of bearer plants, it will be named as self-constructed assets only. Okay, you have to wait for 3 or 4 years to get the yield from the bearer plant. So if you plant any coconut tree, you have to wait for at least 4 to 5 years. Up to the 4 to 5 years, you borrowed and invested and grows and spend lots of money. Now all these costs may be includable in the bearer plant cost. Okay. Now what are called directly attributable costs? Directly attributable costs. So usually cost is directly attributable to bringing the asset to the location and conditions. Okay, you purchase from some foreign country, bring it to your factory and install here, install and test and make it ready for usage. To make it ready to usage, until that period, any cost you incur, that is called directly attributable cost. Like any employee benefits, if it is related to this particular assets manufacture, site preparation cost, initial delivery, handling cost, installation, and to operate this, there may be professional assistants required, may come and guide you, guide other laborers to work properly for a fee. That will also be cost of testing. All these things are directly attributable cost, but which should not be includable. Okay. Introducing new project or services, initial period we have some operating losses. So the machine is capable of producing 1 lakh unit, but in the very beginning year, we don't have proper operations facility, no marketing facilities, we operate for only 5,000 units rather than 1 lakh. So we operated only 5,000. So because of underutilization, so we have huge losses. Can I consider this being the capitalized expenses? No. Initial operating losses will not be includable. Opening new facility, relocating, reorganizing costs, relocating. You already have your setup here, you want to shift here to here. Okay, while you have the operations here, your income is 1 lakh, after shifting also your revenue is 1 lakh. There is no any extra revenue generation. But if you are shifting from here to closer to a place where it may be having good sale potential, probably it may be outskirts, okay. You earned 1 lakh rupees, it's still more outskirts, you can earn the same 1 lakh. But from the outskirts to nearby city or bus stand, your sales may be almost double. If you are shifting from here to here, of course that may be capitalized. But if you are shifting from here to here, it has no any extra revenue, you can simply debit that expenses. Cost of staff training, Okay, also be debited to the P&L account. Administrative and other general overheads can be debited to P&L account directly, not being capitalized. What about the finance cost, sir? That will be as per AS number 16, borrowing cost. AS 16, borrowing cost. Now, entity A has an existing freehold factory property which it intends to knock down and redevelop. So, existing factory premises here is, they want to close completely, they want to develop fresh. Okay. During the redevelopment period, the company will move its production facility to another temporary site. The following incremental cost will be incurred. During the process, for the temporary structure they have here, move all the facilities here and they operate temporarily here. Okay. So after demolition and reconstruction, they can shift here. Until the period, for the temporary purpose, they have the outskirts, some small business area. For this, setup cost is 5 lakhs and install the machine in the new location, and rent for this new location being 15 lakhs and removal cost being 3 lakhs, and to transport the machinery from the old location to the temporary location. Can these costs be capitalized? Definitely not so. So it's a temporary arrangement. It will not have the long-term benefit. The temporary arrangement cost us 23 lakhs means, due to the temporary arrangement, you get the temporary revenue, that may be at least 24 or 25 lakhs. Then it's meaningful. If you don't have, then you simply stop temporary movement. You can stop the business for temporary period and restart once the new structure is ready. Because of the temporary period, this any expenses incurred, we don't have the future any earnability, so it can be debited directly to the P&L account only. Clear? So, the cost of relocation, not the cost directly attributable to the bringing the assets to the location and condition necessary for it to be capable of operating in the manner intended by the management. It's not their own operational intention. So it can be debited directly to the P&L account. Clear? Now, next question. Omega Limited contracted with supply to purchase machinery which is to be installed in its own department in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. So 3 months required to install the machine. During the 3 months period, they have to prepare the foundation also to install it properly. The cost of the site preparation laying foundation were 1,40,000 rupees, without which we cannot use this asset, so it should be an addable item for the cost. There should be addable item. Is that okay? These activities were supervised by the technician during the entire period, who is employed for this purpose 45,000 per month. For this 3 months activity, we debited one person to whom we pay 45,000, means this 45,000 directly attributable to the machine installation only should be addable. This should also be addable. The machine was purchased at 1 crore 58 lakhs addable and was 50,000 for transportation charges. This is also be imputable, were incurred to bring the machine to the factory site. An architect was appointed at a fee of rupees 30,000 to supervise the machinery installation at the factory site. Without the installation, we are not able to use it for intended purpose. So any cost to be paid for this will also be forming part. You are required to ascertain the amount at which the machinery should be capitalized. Come on, tell me. What's the value? You have to add all the 5. 1 crore 61 lakhs 55,000. Is that okay? Should be addable. Next question. Capitalization of directly attributable cost. Entity A, which operates a major chain supermarkets, has acquired a new store location. Okay, one second. Entity A, which operates a major chain supermarkets, has acquired a new store location. The new location requires significant renovation expenditure. Management expects that renovation will last for 3 months, during which the supermarket will be closed. Management has prepared the budget for this period, including expenditure related to the construction and remodeling costs, salaries of staff who will be preparing the store before its opening, and related utilities cost. What will be the treatment of such expenditure? Consider whether it is going to be really having any impact. Okay, it's a new store acquired. New store acquired for probably around 10 lakhs. But before it is operated for the intended use, 3 months remodeling also required. For that it costs us another 6 lakhs, like 2 lakhs per month. For 3 months it's 6 lakhs. Then unless you spend this particular new location is not useful for this. So it should be capitalized. It should be capitalized. Now, operating cost incurred in the startup period. Any cost incurred in the startup period, initially you will have loss only. Beginning period operational loss will not be capitalized. That's how we have seen, right? An amusement park has a soft opening to the public. A trial run its attraction. Okay. Tickets are sold at a 50% discount during this period, and then the operating capacity is only 80%. The official opening day of the amusement park is 3 months later. Amusement park, okay, 3 months later. Management claims that the soft opening means discounted price, okay, giving more discount in the price. Is a trial run necessary for the amusement park to be conditioned capable of operating in the intended manner? No, already it is ready. But in order to what? Attract the public only, you are now selling at the discounted price. Okay, so initial operational loss will not be capitalized. It's strictly stated already in the statement. So it is not going to be includable. It is not going to be includable, or it is simply going to be debited to the P&L account. According to the net operating costs incurred should be capitalized. No, false, and you have to give the explanation properly. Clear? Next. What happens in case of subsequent costs? Subsequent costs. What happens in case of treatment of subsequent cost? Initially you recorded the assets at rupees 1,000. Subsequently you do some additional costs to improve it. How can we treat? Right. In case of cost of day-to-day servicing, repairs only, now repairs and maintenance transfer to the P&L account. What are they? Labor, consumables, spare parts. If I have Xerox machine, to print we need to have a labor. Paper and ink will be called consumables. Now and then some spare parts may be lost, probably 100 rupees or 50 rupees, like the roller. We can debit that directly to the P&L account. And in case of replacement of parts of PPE in regular intervals, sometimes some spare parts may be replaced in regular intervals. I will give around 4 examples here. Okay. In case of furnace, may require relining after a specific number of hours of use. Okay. Now, for example, you purchased an asset for 1,000. Relining is after specific hours of use, means after 3 years you have to reline this. Old relining already included here being 200 rupees and 800 rupees. This is lining expenses. 3 years later, you again spend another 150 rupees. In this 1000, you have to derecognize 2000 rupees, add this 150 back. This is how you can do. Otherwise, this 1000 you can now depreciate after segregating the asset into two parts. One part has maybe 10 years life. The remaining part may have only 3 years life. This will be amortized over 3 years period. This may be amortized over 10 years period. Once in every 3 years, the old one will be derecognized as asset sale. What happens in case of selling the asset? Bank account debit to asset. If there is any profit loss, can be debited and credited. The same way, this will be derecognized and new asset cost will be includable. This will be applicable for furnace. In case aircraft. What happens in case of aircraft? Okay. See, interior separate and aircraft engine and entire body is separate. The body and engine will live for a long life, but the seat and seat cover interior and the decorations may go now and then. Then automatically travelers will complain that seats not working properly. Then it's a duty for the airlines department or agency to change this as a fresh one. So the seats, the galleys may require replacement several times during the lifetime of the airframe. Airframe will have an infinite life, probably around 10 years but these things are supposed to change. Okay. And major part of conveyor system. In case of conveyor system, the conveyor belt wire ropes may now and then will get damaged. So the system will live for a long life, but these things are constantly changing. And what happens? Interior walls of the building will have long life, but the interior decoration will have the short life. So I need to do the interior decorations now and then. See, when I stayed in a hotel, I could not remember, Sterling Resort I think, okay. So I stayed there, the photo seems to be brand new. Okay, the ad says, we run for more than 60 years. 60 years, no, you have the doubt, because during the earlier 60 years older building means we don't have the toilet facilities like what we have in modern days, and the hand shower and all, totally modern. Amazed. And then I surprised, then I realized and I inquired, and then I got the message. Once in every 5 years, all the tiles were broken and reinstalled, and toilets were demolished and restructured. Okay, because of that reason, the core structure remains the same, but that's why they charge so huge bill. Per day stay cost us around 10,000 only. That's how they demand the price, okay, per day. So they want to change the interior decorations also now and then. The outer structure remains as an asset for a longer period, but internal structure will be always changing, okay. Replacing the interior walls of building or make a non-recurring replacement, okay, or to make a non-recurring replacement, okay. In this case, property, plant, equipment recognition conditions are met, means the conveyor belt and wire ropes meets a PPE condition. PPE condition means that wire belt to be replaced will have at least more than 1 year life, and economic benefit should also be there in that case. Included in the carrying amount, so you have to add here, and don't forget to the carrying amount of those parts are replaced is derecognized. Old one will be subtracted and new one will be addable. That's the process you have to do in case of replacement of parts of PPE in regular intervals. Now, third one being regular major inspection costs. We are talking about inspection costs. The earlier one, it's not inspection, it's all about replacement. Okay, it's all about replacement. But in case of sewage treatment plant, no, for an example, sewage plant, treatment plant. Okay, now and then we do major inspection cost. First time cost will be capitalized and eligible for depreciation. Subsequent cost, existing unamortized cost is deducted from the carrying amount, capitalized the subsequent cost and eligible for depreciation. Otherwise, it can be debited to the P&L account. Okay. So you have sewage treatment plant built at a cost of rupees 100 crores by a municipality. Okay. but you have to verify whether it is having a perfect condition or not. For that, you spend around 5 crores every 5 years. But the sewage treatment plant will work for at least 50 years. It has a long life. It's a structure. It will have the long life. Now you have to segregate this value to what? Sewage treatment plant and inspection cost. It may be 95 crores and it may be 5 crores like. Matter of 5 years later, this 5 crores is removed and the additional amount is spent for new inspection will be addable. New inspection cost is around 6 crores should be addable. This 6 crores will be amortized over the period. How many years? 5 years. The 95 will be amortized over how many periods? 50 years. 50 years. Though the asset value will be total one, segregate the assets into two components. One component having life lesser than the other component's life. Then these two components are depreciated based on the applicable life for that asset. Is that okay? Now, if this asset is not having the property, plant, equipment criteria, then automatically can be transferred to the P&L account. It's only expenses can be debited to the P&L account. Now later, what happens, you know, dismantling and removal and site restoration cost. In case of dismantling and restoration cost, it may be recorded at present value. You purchased an asset for rupees 100, realizable value being 20, then 80 will be called as depreciable amount. Okay. See, you depreciate, if the life being 4 years, you can depreciate over the 4 years period. Every year you can depreciate 20 rupees. Cost being 100, we don't have the resale value by the end of the life. But by the end of the life, we have to dismantle and discard. For that, we need to spend some additional money also, probably around 10 lakhs. Okay, maybe 10 lakhs. Is that okay? That's what about dismantling and site restoration cost. Okay, site restoration cost. Clear? So here we have the cost and site restoration cost also. Come on, tell me. In case of revenue, you can subtract. In the case of cost, you have to add. So 110 you have to amortize over the 4 years period. So 22.5. Sorry, how much? 27.5. 27.5 will be the depreciation hereafter. Provided this 10 you know will be nothing but present value of the dismantling cost. You have to consider the present value, discount it and consider the today's value, and you can show here. Dismantling, removal, storage cost. Recognized and measured as per AS number 29, incurred on property, plant, equipment which is used other than productive capacity, capitalize this. Okay, it should be recorded at present value. PP which is used to produce inventories and AS2 will be applicable. Whether it is going to be considered as an asset or not. If it is going to be considered as an asset, it can be capitalized. While capitalizing, present value should be capitalized because this amount could be payable only by the end of the life. Is that okay? Now, valuation for special cases. Payment is deferred beyond normal credit terms. Then you have to take only cash price. If you are purchasing in higher purchase, what happens? You should not add the interest. You have to consider only the cost. Cost price being 1000, cash price being 1000. Means if you pay the money immediately, you have to pay only 1000. But if you ask the delayed settlement, probably 3 years, they will add interest component here 200 rupees. Now they demand 1200. That 1200 is called as HP price, higher purchase price. Now in this case, what is the value you have to show for the asset? 1000 rupees. But for the 3 months delay, 1000 rupees cash price. Okay, if you pay it in today itself, 3 months period, if you are making the payment today itself, there's a cash discount of 50 rupees, 950. In this case, you can consider 950. Okay, 950. Actual price you paid will be considered. So in case of hire purchase, deferred beyond a normal credit period, then cash price. But if I pay in 3 months time, then I can consider 1000 rupees as my cost. If I pay immediately, get 950 is your cost. 3 months credit period is given, so I enjoyed the 3 months and I paid 1000 rupees, then the cost being 1000. But I enjoyed 3 years credit period and paid 1200 rupees. In that case, 200 will not be includable. The extended credit period interest component will not be forming part of the cost, so balance will be considered here. Number 1. Is that clear? And now, PPE acquired in exchange of non-monetary assets. Okay. Or combination of monetary and non-monetary assets. What is called monetary assets? Let's see. Monetary assets is nothing but the asset will have a constant value as per the terms of agreement, will not get affected due to the inflation like debtors. See what happens now, the stock value being 1000. Customer comes and tells me, sir, I want the stock. Okay, take it with you. Sir, I don't have the cash. No problem, sir. 3 months credit period is there. So no, sir, I always pay and carry. I'll pay the money and carry. So I'll come bit later. 3 months later he comes, by the time that stock value is increased from 1000 to 1200. Now tell me, how much we have to pay? This is 0th period, this is 3 months later, okay? Now, if he purchases today, 1000 rupees. If he delays and comes after 3 months, he has to pay 1200 because the price of the stock is increased. Now I tell him, so today the value is different, 1200. But instead of that, if he accepts the credit term, okay sir, I'll take today. And today he takes in credit. What's the journal entry here? Okay, purchases to cash. How much? The purchases to creditors. What's the value? 1000. What happens in the case of third month end? He has to pay only 1000, right? So here third month end he comes and pays only 1000 rupees. Because of the inflation, there is no any impact in the debtors. I cannot say, sir, you purchased 3 months ago, it's 1000, sir, today the value is 1200, give me 1200. We cannot argue. The 1000 rupees is contract value. We have accepted that this is the amount you have to pay me. It's a contract value. There will not be any change because of the inflation. Those kinds of assets like debtors, BR and bond, commercial papers and all these things, no, what the value quoted is the final. So it will not have any impact due to the change in the market value. So then this is called monetary assets. Non-monetary being stock, assets, fixed assets, all these things are falling under non-monetary assets. Is that okay? Now what happens? What happens? A sells the goods or assets, property, plant, equipment, and here the payment being after 3 months. Here for him, property, plant, equipment to what? A. To what? A. This is the main scenario. Main scenario. A and B, property, plant, equipment comes here and property, plant, equipment, old is given. Old is given, exchange, and A to B, property, plant, equipment purchased, old property, plant, equipment given, plus balance amount will be payable later on. Until that period it may be the creditors. So first scenario, property, plant, equipment acquired in exchange of non-monetary assets. This one, first scenario. Or combination of monetary and non-monetary assets. Second scenario. Hope you will be now able to understand. I purchase the property, plant, equipment. Instead of that, I offer you old plant and machinery. Some payment will be done later on. That's what about the non-monetary assets. Okay. In this case, cost of exchange of assets. Okay, in this case, exchange, these two are exchange. In this case, how can I value the cost of the assets? Check whether there is any commercial substance in that. Okay, assume commercial substance does not exist, then book value of the assets given up. Book value of the assets given up. This value, this property, plant, equipment, today being 100 rupees, the property, plant, equipment old given no, this value being 80. So if there is no commercial substance, then 80 will be the final value for the new assets. New asset you purchase no property, plant, equipment, that value will be recorded at rupees 80 only. The given up asset. What is the asset given up? The old asset. If you are losing the old asset, no, the old assets book value will be the assets, new assets value. Okay, provided there is no commercial substance, means there is no any intention to make any profit because of this exchange. If we don't have any profit intention because of this exchange, then book value of the assets given up will be the value of the assets taken up. What happens, sir, if the commercial substance profit exists? Whichever is more evidences available will be taken. So fair value of the asset given up, the fair value of the asset given up being assumed to be 80, fair value of the asset taken up assumed to be 100. Okay, between these two, whichever is more evidence, not whichever is more more, or whichever is more or whichever is less, that will not be here. More evidence, which is more clearly available, you can take. So the asset given up, no, its fair value is clearly, I am aware about that, sir. Then you can take this one, sir. I have the doubt whether it is correct or not, but I am sure this value is 100. Then you can take the 100 rupees. If there is no any commercial substance, okay, commercial substance, then asset given up value will be taken. Commercial substance means profit. So I am giving the old and getting new. I have the intention there is a profit in this. Okay, so my book value is 80, but his book value is 100. I am purchasing that new asset 100 rupees by offering only 80 rupees. Then indirectly I am taking some advantage, means automatically what I have to do? Find out the fair market value of his, the asset taken up, asset given up, and between these two, whichever more evidence will be taken. Logically more evidence will be taken. So what happens, sir? Some monetary consideration is also there, sir. This is called monetary consideration. The monetary value is deducted from the above value. The monetary value is deducted from the above value. Okay. If it is being purely non-monetary, okay. If there is any monetary value, find out this one. Finally, you subtract the monetary value. Okay. We'll see an illustration in this regard also, no problem. So you'll be clear with that. So, before I move on to the last three more points in this, let me finish up two examples to make you understand this one better. Okay. Consideration received comprising a combination of non-monetary as well as monetary assets. Entity A exchanges land with a book value 10 lakhs for cash 20 lakhs. So A and some third party. He gives the land, book value being 10 lakhs for cash 20 lakhs and plant and machinery valued at rupees 25 lakhs. And plant and machinery 25 lakhs. What will be the measurement cost of the assets received? Okay. Now we have what? Exchange for cash and non-cash. Consider the transaction has commercial substance. If we don't have the commercial substance, the fair value of the book value of the assets given up will be final. Here you see, my land book value is 10 lakhs. Now see here, land value is 10 lakhs. I am giving my land and getting cash 20 lakhs and plant and machinery 25 lakhs. What does it mean? How will I give 10 lakhs rupees worth of land as per my asset value in the books? Indirectly I have the intention to make some profit by giving. There is a commercial substance. Okay. As there is a commercial substance, definitely we are sure that land will not be worth rupees 10 lakhs. I cannot write the land's value for the plant and machinery. If we don't have the commercial substance, the plant and machinery value is only 10 lakhs. The asset value given up will be taken. 10 lakhs minus any cash benefit should be subtracted. Okay, 10 lakhs minus 20 lakhs. So the plant and machinery value being minus 10 lakhs. No, it's not possible. There is a commercial substance. There is a commercial substance. In this case, the value of assets taken up and given up, which is more evidence will be taken. Here it is a book value, but here we assume this is being the fair value. Okay. So as it is more evidence clear, we can take the plant and machinery value being 25 lakhs. Plant and machinery value being 25 lakhs. Is that clear? Now let's move on to the next question. Exchange of assets that lack commercial substance. We don't have the commercial substance, then fair value of the assets given up will be final, right? Entity A exchanges car X with the book value rupees 13 lakhs to somebody else, to, okay, to B. That's how we can assume. What he gives? Car. What's the book value of the car? 13 lakhs. And a fair value of rupees 13 lakhs, 25,000 for cash, 15,000 for car. With a book value of rupees 13 lakhs and a fair value of rupees 13 lakhs 25,000. Okay. Its fair value being 13.25 lakhs. This is given for cash 15,000 and car Y. This is car X. You get car X, car Y. Its fair market value being 13.10 lakhs. Sorry, 13.1 lakh. Okay. The transaction lacks commercial substance. The company's cash flows are not expected to change as a result of exchange. It is in the position, it is in the same position as it was before the transaction. What will be the measurement of the cost of the assets? Earlier also he has car, now also he has the car. Because of he acquiring the car, there will not be any commercial substance, profit increase happening, then commercial substance is absent here. If the commercial substance is absent, then what value will be taken? The book value of the asset given up is final, and from that monetary asset will be, monetary value will be subtracted. If monetary value 15,000 is subtracted from 13 means 12.85 lakhs is final. 12.85 lakhs is final. Is that clear? So here lack of commercial substance, earlier case commercial substance exists. Let's now read the theory so that now you will be able to understand this concept much better way. Is that okay? Now already told you know, we have monetary and non-monetary. Monetary includes money, debtors, creditors and all monetary. Okay. If commercial substance does not exist, then book value of the asset given up will be taken. In case of commercial substance exist, then fair value of the asset given up or fair value of the asset taken up, whichever more clear no, that will be taken. From there, any monetary value is there no, can be subtracted for finding the value of the assets taken up. Clear? Now, next one being third, at consolidated price. At consolidated price. Consolidated price means you purchase 4 or 5 items, 5 assets. For 4 or 5 assets put together you paid single consideration. Then how can you find out the consideration for each and every assets? When you are taking the business, you take all the assets and liabilities put together for a common consideration, say 50 lakhs or 20 lakhs like. Then how do I know what's the value for property, plant, property 1 and plant 1 and machinery 1? Then apportion under fair value basis of competent valuer. You need to have the competent valuer and ask him to give the certification about each and every asset's value. Okay. And property, plant, equipment held by lessee under finance lease. Okay, and government grants related to PPE. Okay, these two how can we answer, sir? In these two cases, go and refer the concerned A's. In case of lease asset, property, plant, equipment, especially you are holding the asset under finance lease, then A's number 19 will be applicable. In case of government grants relating to the PPE, then A's number 12 will be applicable. So we will be studying that under government grant chapter, no need to worry about that. So there will be covering all these aspects. Is that clear? Now, we will move on to the revaluation scenario. Revaluation. This revaluation concept you might have studied in your depreciation chapter at foundation level. Okay, let's see. Let's see. I'll explain with an example so that you will be able to understand much easier. Cost of the asset being 100, depreciation for the first year 20, depreciation for the second year 20. This is the WDV. Actually, what we do now, we go for valuing its worth today. A revaluation will do now and then. Okay. On revaluation, we came to know this value is either 50 or 70. 50 or 70. This is revaluation. If the value being 50, there is a further decrease 10, you know what you can do. 10 rupees loss, what you can do? In case of loss, can be debited to the P&L account. Okay. From this, it's very clear. First time, loss can be debited to P&L account. In case of gain, you add the 10, right? It's a gain named as revaluation reserve and credit it. In case of profit, first time, this will be credited to revaluation reserve account. It should be credited to revaluation reserve account. Is that clear? First time. See here. Initial revaluation. Upward means gain. This will be credited to the revaluation reserve. Downward means loss debited to the P&L account. Hope you will now be able to understand this one. Right. Now you claim the depreciation for the year 3. 20 rupees. We assume the depreciation being 20 rupees every year. So now the WD value being by the end of third year 30 rupees or 50 rupees. 50 rupees. Again you go for revaluing this. Now while revaluing you find out that the value being either 25 rupees or 35 rupees gain or 45 rupees. Okay. Now second time onwards. Okay. Here we have the loss. If we have loss, what you have to do? Check whether there is any profit earlier. Check there is any profit earlier. If there is any revaluation credit balance, okay, then debit this. No sir, no revaluation reserve. Then debit to P&L account. Okay. So in case of subsequent period loss, you have to first check, is there any revaluation reserve? Any revaluation reserve? Okay, sorry. Revaluation reserve. Yes or no? Yes means debit revaluation reserve. No means debit to P&L account. So here we don't have the revaluation reserve, so that 5 rupees can be debited to P&L account. Is that okay? What happens here? 45. Okay. $35, $55. In this case, there is a loss of 5 rupees. Loss of 5 rupees here. If the loss of 5 rupees, but in this scenario earlier we have what? Revaluation reserve. Then first you debit to that extent. So, debit revaluation reserve, debit revaluation reserve with that 5 rupees, with that 5 rupees. Second scenario also loss, 50 becomes 35, how much is the loss? 15 is the loss. 15 is the loss, but how much RR we have, revaluation reserve? So only to that extent revaluation reserve is debited. Beyond that another 5 rupees you have no, that can be debited to P&L account. Because we already used it. Clear? In case profit, here we get the profit. Again, have you debited P&L account earlier? Yes or no? If you are making any profit in any year, with respect to the same asset, have you made any loss in the previous year? Go and check. If so, then to that extent, credit to P&L account. Beyond that, if you get, what do you have to do? You can credit the revaluation reserve. Credit the revaluation reserve. So now we made a profit of 35, 5 rupees profit. Do we have any loss for this asset earlier? Yes, how much? 10 rupees. To the extent of 5 rupees can be credited to P&L account. Here 45, 15 rupees gain. Earlier we had 10 rupees in the debit side, so I am reversing that. P&L account, credit to 10. Beyond that, revaluation reserve account, credit 5 rupees. Next year, revaluation reserve 5 rupees is there. No, if there is a loss, you can adjust that in the revaluation reserve. This is the second year onwards. The last case here, 55, gain. If there is a profit, check whether there is any revaluation loss earlier debited to the P&L account. No, then this will be credited to the revaluation reserve account only. Okay. Subsequent revaluation upward profit case, first credited to the P&L account to the extent already debited. If there is any already debit in the P&L account related to the loss, then to that extent credit. Balance can be credited to the revaluation reserve. In case of downward, means loss scenario, first debit revaluation reserve account to the extent already credited are available. Yes, balance can be debited to the P&L account. So this entire concept is explained in this chart. Is that clear? Who can revalue the assets? Some competent authorities competent persons can revalue. You will study that in a different chapter, impairment loss. Okay, under section under the AS number 26, 28, impairment loss. Under AS number 28, you will study that. No need to worry about that. That will be available for the CA students, not for the CMA students. Not for the CMA students. Okay. Now, entity A is a large manufacturing group. It owns a number of identical buildings such as factories, warehouses, office buildings in several capital cities. The industrial building are located in industrial zones, whereas the office buildings are in central business districts of the cities. Entity A's management want to apply revaluation model as per AS number 10 to the subsequent measurement of the office building but continue to apply the historical cost model for the industrial building. State whether this is acceptable under AS number 10 or not. Usually it is not acceptable. Once they go for the revaluation, they have to do revaluation completely, class by class basis, okay? We'll see the detailing here. Can apply because office building is different from industrial building. But in case of industrial building, you cannot skip. If you have two industrial building, you can revalue both the industrial buildings simultaneously. Yeah. Next one. Next one. Frequency of revaluation. So, if the value gets affected significantly, usually you do the revaluation annually. If the value, the revaluation requirement will be insignificant if the change happens rarely. Revalue once in every 3 to 5 years you can do. How can you determine the fair value? Market-based evidence by a qualified valuers you can determine. If there is no market-based evidence, income approach is used. You have asset A, this asset is available in the market. If I sell this asset what we have today after the usage, what is the value I can recover also be an evidence for this. Or I have the asset B which is a special equipment, I am the only user, no other users are there for this asset. If I sell, no one will purchase, then what can I do? What is the revenue I am able to generate because of the asset B? The revenue generated because of asset B being 1000 rupees per year for 5 years. Then you have to find out what is the present value of this 5000 rupees. 1000 rupees for 5 years means 5000 rupees. You have to discount this to find out the present value. After cost of capital, probably 5% or 10% if you discount, it may be around 3000 rupees. No, that will be called as your value. Or you can compare with the cost. This is called income approach. And another approach being, if I want to replace this new asset with the new asset, already I have the B asset, I am the only user. But if it goes out, then I have to purchase fresh and install fresh for my business purpose. What is the cost I have to spend? That is called replacement cost approach. Discounted cash flow projections and replacement cost after depreciation. What is the cost I have to spend for purchasing and replacing the new one for B? It costs us 1500 rupees. But already it is a used one. For the 3 years usage, normal depreciation maybe 600 can be subtracted. Then the 900 rupees is considered as depreciated replacement cost of the asset. The cost of this asset to replace being 1500. But it is not new one, it's an old one. To the old one, you subtract some nominal depreciation, that's what about the cost approach. Hope you will be able to understand the way of determining the fair value of the asset. Now what about the depreciation? Depreciation is nothing but allocation of depreciable amount over the useful life. Depreciable value is nothing but cost minus residual value, that you know already. Okay. Component method of depreciation, that's the uniqueness of PP. I already told you know. Any asset you have, some spare parts in that may have the different life, means you have to do two components like, and each and every component will be depreciated separately based on the life applicable for that. A part of PP with significant cost will be called a component, should be depreciated separately. Is that clear? Now, how can you account the depreciation? General model is any amount depreciated can be debited to the P&L account after subtracting from the PPE. Okay. General PP. In case of manufacturing PP, property, plant and equipment related, the depreciation will be debited to the manufacturing account. You might have studied the final accounts, right? Trading account, P&L account. Sometimes you have the manufacturer account also. Manufacturing, trading and P&L account. If I am being the manufacturer come trader, the plant and machinery related to the manufacturing, and the depreciation related to that can be debited directly to the manufacturing account only, not in the trading account or P&L account. Is that okay? So in case of depreciation for the manufacturing property, plant, equipment, that will be part of the cost of inventory. Cost of the inventory means it should be added to the production cost. In case of development activities for any intangible assets, this depreciation will be forming part of the intangible assets itself, right? Any brand or technical know-how you are developing, for that, if you are using any assets, the depreciation part will be the cost of the intangible assets you are producing or generating. Now, next part is all about okay, change in accounting estimates. AS number 5 is incorporated with this. What happens, sir? I purchased an asset for 100 rupees and I assume the life being 5 years. So first year, under SLM method, you depreciated 20 rupees, now 80 rupees. First year end, again you re-verified what about the life of the asset, sir. If you go and see, the asset is sparingly used and the entire system is good condition, still it has another 5 more years. So still it has another 5 more years means the second year depreciation being 80 divided by remaining life of the asset 5. 16 will be the depreciation. Is that clear? So the useful life as well as residual value or both are estimations only. Year after year those value may be affected. So you have to now reincorporate with the residual changed residual value and useful life for the calculation of the depreciation. Also you might have studied in your depreciation chapter at your foundation level. So residual value and useful life should be revalued at the end of every financial year, and based on that you can charge the depreciation. Okay. And commencement period for charging depreciation, when you use the depreciation, when the asset is available for use. We studied that in direct taxation also, put to use and passive use and active use and all. If the asset is ready for usage from the date onwards, you can start claim the depreciation. If the asset is under construction, of course you cannot claim the depreciation. When you stop claiming the depreciation, when the residual value is more than carrying value. So 100 rupees, you depreciated 80 rupees, today it's 20 rupees, but today's residual value is 25. After the depreciation, this value is 20. If I want to sell in the market, the value is 25. So the residual value is more than the carrying value. The amount recoverable is more than the value appearing in the books, then you no need to depreciate further. Or when the property, plant, equipment retire from the active use, hereafter the asset, yeah, of course it will be working, but I don't want to use it anymore. There is no economical value to economic benefit because of usage, you can keep it. So some assets in your home, maybe working better. So still I have the two in play, the tape recorder also in my home, and it has the FM radio also. It was in the loft some years ago, was purchased around 20 years I think. When once we cleaned that, we got that. We tried whether it's playing, it's still playing. Now what happens, still, are we going for playing? No, we already have very facilities in our mobile itself, so we never know that. The asset has a life, but we now stop using that because of other purpose or other facilities, retired. Then you can stop creating the depreciation, and PP is derecognized. Derecognized means sold out. So you don't need to depreciate thereafter. Is that clear? Now, next one. What are the methods of depreciation as per AS number 10? Already you studied, the same. Two methods are predominant. One is a straight line method, another one is WD method. Rarely we have this method also, third one, units of production method. If the asset can be linked directly with the output it can generate. For example, I have the plant and machinery. That plant and machinery will help me to produce 100 bikes. Okay, then the cost will be amortized over the 100 bikes. That's what about the depreciation method under units of production method. Okay, revenue basis depreciation. This is otherwise called revenue basis depreciation. Usually inappropriate. So you can stand with these two methods itself and review. So if I follow the straight line method, sometimes later I came to know reducing balance method is better than SLM method. Can I shift Yeah, of course, you can go on do reviewing every year whether the method is appropriate or not. You can then plan to change or not. Method of depreciation should be reviewed at the end of every year. Change the method of depreciation also if needed. Okay. How can I account that change, sir? You have to go and study AS number 5 for that. Okay. AS number 5. That you might have studied in your foundation level itself. If you are changing any method from SLM to WDV, how can we treat? Those things are available at foundation level itself, right? Now, changes in existing decommissioning, restoration and other liabilities. Okay. The cost of property, plant and equipment adjusted due to the following changes. Changes in liabilities, price adjustment and changes in duties, changes in initial estimation of the asset and similar factors. Okay. These things also mean changing your assets value. You purchased an asset for rupees 1000, not 1000 rupees, maybe I assume this way. I purchased an asset for $1,000. Today, at the time of purchase, the price being 80 rupees per dollar. So your cost of the asset being 80,000 rupees. But you purchased in credit. So you have to pay the amount 1 year later. By the time, once you plan to pay, by the time the dollar becomes 85. So now you have to pay how much? 1085, 85,000 you have to pay. 5,000 rupees additionally you are paying, that 5,000 can be added with the cost. So the cost also gets affected due to some reasons. Okay. So changes in liabilities. This is called changes in liabilities that you might have studied in your taxation also, section 43A. If you are purchasing the asset from foreign country in foreign currency, due to the fluctuation in currency, if you're supposed to pay extra money, that will be adjustable with the cost. So here also I'm adjusting. The liability is increasing from 80,000 to 85,000, but in dollar it remains the same, 1,000 rupees. And some price adjustment. The supplier says, sir, the asset I supplied, as you asked some extra requirement, I calculated the additional cost for that, just pay me that additional cost also. So now because of the price negotiation, supposed to pay extra money, that will also be addable. If the price negotiation decreases the price, that will also be adjusted. And changes in duties like ITC reversed, supposed to be amount is payable and all. And any initial estimates of the amounts provided for dismantling and removing. So these are only estimation. No, 5 years later you need to spend 5 lakhs rupees for the dismantling. So you consider the present value of the 5 lakhs being your cost. But 5 years later what happens? 1 year or 2 years later you estimated that dismantling cost rise to 10 lakhs. Now you have to recalculate the 10 lakhs as your dismantling cost and add with that remaining value of your asset. So these are the similar factor changes the asset. So in case of depreciation, original value minus scrap value divided by life. Original cost also be getting affected, scrap value also be getting affected, life also be getting affected. So depreciation will also be getting affected. So these things are valued now and then periodically depending upon the changing factor. Is that clear? Now, accounting for above changes. How can I account this? If the related asset is measured using the cost model, plus or minus with the related assets. Okay. Now, this will be similar to revaluation model. You just check, you can easily understand this one. Revaluation reserve and this one. This change will also be similar to revaluation account, like you can treat here. So there will not be any complication to understand this one. So I'll move on to the next one. Situation and its accounting. Impairment of assets. How do I handle, sir? Go and refer AS number 28. If the asset is derecognized, how can I handle AS number 10? Compensation received from third parties for items of PPE. Okay. Then what can you do? Is included in determining the profit or loss when it becomes receivables. Okay. See, the supplier told me the asset will come for 10 years life. But matter of 3 years itself, we came to know the asset will not work for more than another 3 years. I immediately complained him, yes sir, sorry, no worry. I'll refund some amount. Some compensation will be refundable. So in that case, any amount we supposed to get refunded will be transferred to the P&L account. Okay. So where impaired, lost, given up may be compensated by the third party is included in determining the profit and loss. Okay. When it becomes receivable, it may be includable in the profit and loss statement. And cost of the items of PPE restored, purchased, constructed or replacement is determined in accordance. In case of replacement, all we have already studied, the same is given here. See here for your better understanding. NTDA carried plant and machinery in its books at rupees 2 lakhs. These were destroyed in fire. Plant and machinery, they have costing rupees 2 lakhs, destroyed in fire accident. The assets were insured new for old, and were replaced by the insurance company with a new machine that cost rupees 20 lakhs. Now this machine is destroyed. No, insurance company gave me the new asset worth rupees 20 lakhs. The machine were acquired by the insurance company and the company did not receive 20 lakhs in cash. So they don't get this 20 lakhs in cash because in insurance, anything damaged, you will get the cash compensation. Sometimes new replacement compensation will also be given. So here, new for old. Old is lost in fire accident, so you will be getting a new one worth rupees 20 lakhs. How can we record? You derecognize and recognize this one. Okay. See. The old one is derecognized from your P&L account by debiting to the P&L account. New one 20 lakhs. It's a claim, For the claim, AS number 29 will be applicable as per that provisions you have to recognize. Okay. On receipt, the asset is measured at fair value. Fair value is 20 lakhs. Fair value is 20 lakhs. You have to connect with AS number 29. Once the asset is disappearing from you, it should be derecognized. It should be derecognized. Now, retirement of property, plant, equipment from active use and held for disposal. Stop using it. Sometimes later you plan to dispose. Until disposal, it is now available in your premises ideally. In that case, how can you record that assets are carrying amount, net realizable value, whichever is lower. Okay. Then any profit or loss, what can you do? The same. In case of loss, first, if there is any revaluation reserve, debit there, else you can debit to P&L account. The same logic will be applicable. Derecognition on sale. First one is not sale. Supposed to be sold later on until the period is kept. On disposal again you will get the profit and loss also. Okay. On disposal, by sale, by entering into finance lease, whatever it may be, when no future economic benefit is recovered. Okay. Accounting treatment. On disposal, AS number 9 can be applied. Okay. Or the difference between amount collected, carrying amount 80, this is the profit and loss. Or you sold for 80 but the carrying amount being 90. So this is cash, this is the carrying amount. In this case profit, in this case loss. Okay. That profit loss can be transferred. Normal, no. What happens if you sell the asset for a profit or loss? Transfer that profit loss to the P&L account. No, the same condition is given here. No problem. So seems to be, the terms are all used to seems to be new one, but nothing but the same. If you are selling the asset, what happens? But you supposed to sell later on period, but I am keeping it ideally. What can we do? Not sold, but ideally kept means book value or fair market value, realizable value that by the time. Between these two, whichever is lower will be taken. The loss due to that will be adjusted in the revaluation reserve and profit and loss. Right. Once all the things are completed, how can you disclose? How can you disclose? Disclosures. Each class of property, plant, equipment will be disclosed separately. This is the main one. Measurement basis, depreciation method, useful life or depreciation rates used, gross carrying amount, accumulated depreciation. Okay, usually you have to do opening value, purchases, disposed, closing value, depreciation, closing value. This is how you have to give the full details in your financial reports. Okay, that is called reconciliation. That is called reconciliation. This is the basic general. Whatever the asset you have in the beginning, how much asset you have, what is the additional asset you purchased during the period, disposed asset, any depreciation claim, the depreciation will be accumulated year on year. Okay. Usually we will subtract the depreciation year on year, no. But as per the recommended method, the depreciation are going to be accumulated so that the original value of assets will be known always, and depreciation from the date of purchase to the date of sale, how much also be aware about. Okay, clearly. Additional. Any pledge or restriction on title, if you are not being the owner due to the pledge, you have to intimate. Any expenditure capitalized during the construction period, any contractual commitment, any compensation received from third party, why do you keep it away from active use, all these things should also be disclosed additionally. Okay. And in case of revalued asset, what asset, when revalued, who revalued this, and what are the assumptions you have done for that, all these details also be disclosed in case of revaluation. Is that clear? So these are the points you have to understand for AS number 10, property, plant, equipment. Okay.